Welcome to another Market Radar podcast. It's Sunday, October 23rd. Let's look at what the market is doing so far this year. S&P is now down 21.2%. NASDAQ is down 30.77%. The Russell is down 22.36%, and the Dow is down 14.43%. All of these indexes continue to be bearish trend. We are still in stagflation. We have a 58% chance of risk off, and we did see a pretty large uptick in inflationary odds. It's still quite a bit behind stagflation, but it is something to keep in mind that we do have the possibility of a risk on rally still. It's not totally ruled out. It's something that a lot of people probably don't even expect, and that just makes it even the more possible. Let's look at the calendar for next week. Monday, we've got PMI composite flash. Tuesday, we've got Case-Shiller home price index and consumer confidence. Wednesday, we've got international trade in goods, new home sales, EIA petroleum status report. Thursday, we've got durable goods orders, GDP, that's going to be big, jobless claims, EIA natural gas report, and the Fed balance sheet. Friday, we've got personal income and outlays, employment cost index, consumer sentiment, and pending home sales index. Gamma's going to go through last week's recap with you guys.
Yeah, so last week we had the New York Empire State Manufacturing Index well off its highs, printing well off its highs, but historically not oversold. We had the Industrial Production Index print a new index value high. And again, positive rate of change figures here with the new high. So month over month, plus 38 basis points, and year over year, plus 533 basis points. So again, not really a bearish signal here yet. We had United States building permits. Again, major ROC figures remain negative on this. And this echoes the issue of higher interest rates. Month over month is plus 143 basis points, but year over year is negative 316 basis points. So still overall a decline with a short bounce there. Then we had United States housing starts, another echo of the effects of higher rates and restricted capital. Month over month, negative 811 basis points, and year over year, negative 770 basis points. So again, while this is not down a lot compared to where we saw this in 2008, it's still down off the highs, and it's still echoing the effects of restricted capital. We had the United States crude oil inventories. They continue to print in negative territory on a monthly basis, and this is bolstering energy prices. Remember, I've been saying this for a few weeks now. The more frequent the prints in either territory, they dictate a move in the opposite direction. Meaning, more prints in positive territory are meaning that there is more. It does mean that there's more supply of oil and lower prices. And it's when prices are congregating in negative territory that they tend to push oil prices, or stocks are congregating in negative territory, it tends to push oil prices higher. So we had jobless claims, still super low, right? On a monthly basis, we're well under the July highs, and it's continued to signal that the labor market does remain tight. Month over month, it's up 12.63%. But we are still down 23.57% year over year. So again, labor market remains tight, something that we're watching, but the Fed is watching this too. So they more importantly, the jobless or the employment numbers, right? The unemployment rate. So as long as this stays low, it's going to be hard for the unemployment rate to really break out. And unless that really does break out, I don't see why the Fed would jump to stop the rate hiking cycle so quickly, or pivoting. Then we had the United States Philadelphia Fed Manufacturing Index, not extremely oversold yet. Again, we're above the 2016, 2012, and 2008 values. COVID obviously was a black swan event, so we don't really count that. We're negative, but we're not too negative, so not too bearish yet. And then finally, we had the United States existing home sales. Now, new lows, right? So we're seeing new lows here as the home, or I should say, the rate at which people have access to capital is slowing because interest rates are rising, and the home pricing the home repricing event hasn't really taken place yet. Those homes that were getting valued at like 3-4% rates, well, rates are north of 7 now, and we haven't really seen a big repricing event, which is going to slow home sales because less and less people are going to want to overpay in a current environment for homes with much higher mortgage rates. And I would assume that this is going to continue to slide until we start to see that home pricing event where we can get an influx of buyers, and that doesn't seem to be happening just yet. And I think we can go into the overview of what the FOMC curve is displaying for the next few Fed meetings. And this is important because next month we're looking at a pretty much 100% baked in chance of 75 basis points, and then a 45.7% chance of 75 basis points again in December. This actually decreased a bit. The terminal, meaning the peak rate at which the Fed is expected to get to before cutting, it decreased on Friday after the quote unquote Fed whisperer came out and said that the Fed is thinking about hiking, pausing, and maybe going slower, right? And then you had Daly speak as well, and the Fed Daly, and he was pretty much in injunction with saying that the Fed needs to watch what they're doing. Don't want to go too fast. You need to slow down. You don't want to over tighten, but want to tighten enough. I think this is all just a lot of smoke in the air, right? Because no one really cares about over tightening if inflation isn't fixed, right? The only problem that of over tightening, like if you over tighten, you only really see that issue if you get a massive deflationary event, which is likely going to be the consequence of this whole low interest rate environment for a long time, and then huge COVID stimulus. We're likely going to have an over tightening event that occurs. But the reason why it's very important that you pay attention to what they're saying is because they're trying to chase inflation with a leash, right? It's okay. Think of it like I'm gonna go duck hunting, right? And I shoot a duck, okay, and the duck falls in the water. My dog's gonna swim out there to get the duck. But imagine now I tie a leash to the dog, and I'm gonna swim out there with the dog. It would take me so much more time to get to that duck. Now, that duck may have floated downstream in that process of me trying to get that duck. But now I'm following that I have to go further and stay in the water longer than if I were to just let the dog run and get the duck and come back. And that's pretty much the situation we're in. The Fed is almost strapped down when they're trying to do this. They don't want to over tighten, but in reality, you're chasing a runaway train, and you got to make sure that you're chasing it at a fast enough pace to get in front of it and stop the train from running away from you indefinitely.
Yeah,
And
because
that's where
in that case we get runaway inflation, and
right.
shit gets way worse.
Right. And that's something, I mean, we're seeing that right now with the effective federal funds rate. The forward curve was above 500 basis points, at or above 500 basis points earlier in the week. But we closed the week just under 500 basis points after that whole Friday Fed whisper fiasco. And I think from here, we're going to go into ES, and we're going to talk a little bit about what has been happening. Artie, you want to take it from here?
Yeah, so it was a pretty slow week. We actually didn't move much this week, and we may get a bear market rally. It's highly possible. We're seeing inflationary odds rise. For this to be a risk on event, we do need to see ES go above Momo and go bullish trend, which, it's a far shot, but we don't want to rule that off the table. And we're seeing the equities are pricing in a 500 basis point curve right now. So, it is possible to bottom out here. We're not going to make any big calls. We just follow the system. But if the system says risk on, it's going to be risk on. I
Right.
know we've
And
been saying that
right.
like deflation is the most likely outcome, and it still is, but we don't want to rule a risk on rally out.
Right. I think it's also important to clarify that, right? We see the impending probabilities rising, or the probabilities of a risk on regime, I should say, rising, right? If it's expansion or inflation,
Yeah.
whatever. Now, we can get something, and I put a tweet up or on Twitter about this 10 days ago, roughly, regarding a confirmatory regime. What does that mean? Simply put, the thread you can find on Twitter, you can read through it. You get a better understanding of what I'm going to talk about right now. But the non-confirmatory regime is basically a regime that pivots without the underlying assets coinciding with the move. So if we get an inflationary regime pivot right now, equities can rally, and the rally in equities could lead to an inflationary pivot, meaning one or the other could feed each other, meaning risk assets start to rally and the regime flips inflation, or the regime flips inflation and the risk assets rally in junction, right?
Hmm.
Now, unless the major indexes like the risk assets, right, S&P, Nasdaq, unless they really flip to a bullish trend, it's what we would call a non-confirmatory regime. It's a regime shift without an asset pricing model shift, which is not the same as a regular regime shift. Just because the regime says inflation doesn't mean we can go out there and recklessly start getting along. We have to make sure that DDAP has our back. Remember, that's the key to our process. One hand washes the other. If
Yeah.
they're not in sync, we're going to get you have a very high probability of getting smoked,
Yeah.
which is why we take it nice and slow. Let the regimes pivot. Let the system, let DDAP put us in the right direction, and there together we have the system. Remember, the system is the regime model, but the system also encompasses DDAP. It's all in one. And if if you ignore one of them, you open yourself up to what we would call a non-confirmatory regime, and that can end badly, because something like this in late July, August can happen again, and you could get the inflation pivot. SPX 4000, excuse me, 4100. Start thinking it's time to get long, chase, and then you get SPX 3500 again, and you're smoked. And this type of risk we did see basically boiling under the surface. And that's why we've been hedging so aggressively, just to mitigate some risk here in case we do get that upside move to Momo. And then from there, if the regime is inflation, maybe some things are changing. At that point, we can make a decision if it's time for a regime pivot if the trend goes in the same direction. But again, risk off at the moment. We don't fight trends. Risk off, bearish trends. We're gonna ride it until it's done. We're gonna ride the bike until the wheels fall off, basically. And
Yeah.
I think that,
Unfortunately, we're still in stagflation. It's
yeah,
not fun, but just got to deal with it.
yeah. And same thing with bonds too. Again, I want to clarify here before Artie goes into what's been going on here, that bonds falling like this. Remember, in inflation, rates go up as well. An inflationary regime. Is it possible that we see a very short 4-6 week inflationary regime and then we go back to stagflation? It is, but that doesn't really change the outlook on bonds, right? Because the regime can go inflation with higher rates, meaning bonds can still go down if you get a non-confirmatory regime pivot. So
Yeah.
we have to pay attention to where bonds are going, but I'll let you take it from here.
Yeah. So ZN came down a bit as we saw with the terminal yields rising. Um, we could very well be seeing a bottom pretty soon here. Terminals at 5% does seem like the market has been hinting at that for a while now, and as it approached 5%, things have been slowing down. So it's very possible that we get a bottom in ZN pretty soon here and get some fluctuations. For us to get a deflationary pivot, ZN will have to go above Momo, which is still pretty far away. So that's not happening anytime soon. But yeah,
Right, and I just want to. I don't mean to interrupt what you're saying, but I think it's important to say that remember the market's pricing in a terminal of 500 basis points roughly by the middle of next year, right? Rates still have to go there,
Hmm.
right? Because you can't just price a terminal and then you fix inflation. We
Yeah,
have to,
exactly.
well, while to a degree, the way the terminals are priced, they are affecting certain things, right? Like they're affecting longer term bond yields because we expect rates to go to that point, right? So we do have to hike there, but it's somewhat baked into the bond market to a degree, right? But we have to understand that the bond market is forward looking to the point where until we get to that 5%, if bonds want to chop sideways, and let's just say inflation is under control, which again, it's showing the complete opposite with core figures. We just saw that we're getting more and more inflation being baked into the core CPI just keeps going up, right? While
Hmm.
headline is chopping sideways, um, and now slowly rising again. But my point is that inflation has bled; it has run away to a certain degree.
Yep.
So we have to we have to see, does a 500 basis points terminal really fix inflation? And typically, the Fed has to get their federal funds rate above the rate of inflation to really cure the problem. But the question is when does that happen next year? Is that the 500 basis point terminal when inflation on a rate of change basis is slowed to a certain point that the Fed's in front of it, right?
Hmm.
We don't know that yet. We have to see that because remember, uh, as time goes on, and let's just say the CPI index is going up at the rate it's going right now, right? As time goes on, if the CPI index were to stop here and go sideways, the rate of inflation would drop eventually to zero.
Yep.
The like the inflation rate that says 8.5 or 8.2, right? It's going to go down to zero.
Hmm.
And like that would satisfy the idea that at some point along that way to zero, the rate of inflation will cross under the federal funds rate. And that whole I want to say that whole theory, right? The Fed has to hike above the rate of inflation would come true at that point of time. The question is, does inflation really buck trend and start falling apart with the Federal Reserve at 500 basis points? And that's the question we are waiting to figure out. And if it is, right, it's going to still take some time to play out. And if it is, right, bonds can also chop here and do nothing for a while. And we've seen this type of price action happen before. If we go back in time, we've seen bonds, for the end of 2018, bonds really didn't go down, but they really didn't go anywhere from the
Yeah.
middle of
And
2018 to all the way to the end.
that's what I think is going to be the most likely outcome here.
Right. And you know how many people that's going to chop up in the process?
Oh yeah, that's max pain. It's gonna chop people up. We're gonna get Momo slowly creeping down, eventually get the bullish pivot, and that's gonna
Right.
be the deflationary play right there.
Yep. And unfortunately, a lot of people, they don't understand that this is not and we're going to talk about we'll talk about this quickly, real quick before we continue. This is not the we look at the EFFR, right? This is not the hike and the cut to zero. That's not what's going to happen here.
Yeah,
The
it's the
hike to
it's
cut
the
to zero
hike,
and
wait,
this is yep,
and then cut
cut well,
depending on the
but
situation.
I don't think they can go to zero too quickly if ever again. I know there's a lot of theories that rates will eventually have to go to zero because of the type of economy we're running. But I think this whole zero policy, given that COVID was a blip and we had to go to zero, right? In reality, if COVID didn't happen, eventually this type of hiking cycle would have continued higher. This
Until
drop in
something broke, and then
Yeah,
they
until
would cut.
something broke. Well, that's what happened in 2018. Remember the Fed like had to at the end of 2018, the Fed had to come take the basically step back and say we're hiking too much, the economy's slowing. You know what I mean? Stuff like that they were
Hmm.
saying, but they ultimately we had a huge deflationary event which we injected a shit ton of inflation into and exacerbated the problem that has been existing for a while that we have it's kind of like the you go to an arcade and you put the coins in and you fill up the tray and eventually the coins at the end fall off, right? It's like there's just one more coin that you need to put in and then the whole thing just falls over.
Yep.
That's pretty much what's going on, and I think this COVID event really solidified that. And I don't think the Fed is going to go to zero or extremely low interest rates for the foreseeable future, and that's the risk on bonds right now. Even, but again, if rates go to 5% and come back down to 3, 2, that's still a great bond trade to be had, right? So we have to understand that we're probably not going. If you look at TLT, I don't think it's going to go all the way back up to like 179, right? Just like a rocket ship, like it did here in 2019. But we have to just understand that for a reason, because the Fed's not going to cut so aggressively, because now they're playing in the shitstorm they created, and I don't think they like it. And I don't think they're going to want to do this again too easily. But unfortunately, when a crisis appears, everyone takes the easy way out. So it's hard for me to really say that for definite that the Fed's not going to go down to zero. As dumb as the stupid amount, the dumb amount of things that they do, I wouldn't be surprised if at some point we end up back at zero for whatever reason. But I don't think it's going to be, at least in the short term.
Yeah.
And
And there isn't really a point in forecasting that far out.
right,
We'll
right.
figure it out when it happens, and we'll make some money off of it like we always do.
Exactly. I just want to go over the market radar illiquidity index, because this, again, I've been tweeting about this, and I mentioned this in last week's podcast, but I want to go over it one more. I'm going to go over it on a weekly basis to make sure we stay on top of this. The illiquidity issue is rising, right? That's what this index is measuring, the conditions of illiquidity. So the higher this goes, the worse the conditions are. The lower it goes, the better the illiquidity conditions are, or vice versa. The higher this goes, the more illiquid. The lower this goes, the more liquid. We are above the 2020 peak, which is kind of scary, right? Given that we all remember what 2020 was. People were afraid to get cash, lockdowns, all this shit.
Mm-hmm.
But the Fed basically backstopped that quickly and fixed that issue. Now we kind of have the opposite going on. This just continues to chug higher, and VIX is not ripping yet, which, as this widens, you basically increase the tail risk of a volatility, right? Because this going up is just meaning more and more the conditions are more and more heightened of the the liquidity conditions are more and more heightened, which means volatility itself is going to be heightened as well. The fact that VIX is not moving up yet is quite interesting. At some point, these will meet again. So the question is, does the liquidity index break lower, or does the VIX index break higher? I like to think, based on looking at this chart, VIX will follow the liquidity index. So we have to watch this closely on a day-to-day basis.
So what is suppressing the VIX right now?
There's a lot of That's a good question. I would think that it has to do with the fact that markets aren't breaking down, and I have this really, like, this intuition that it has to do with the way the Fed's playing the game, right? Like, this, first off, the liquidity index that you see here, I'm sure the Fed has their own metrics, right? Some may not be public that they look at with liquidity.
Mm-hmm.
Now, I'm sure they understand that the markets are very illiquid at the moment. And remember, we have this whole every time before a Fed meeting, right? There's always this idea that there's going to be a pivot.
Yeah.
You know what
Before
I
every
mean?
single meeting, yeah.
Yeah. So it's like, and then like just back in remember this, after the Fed meeting here, I think it was on the 20. I think it was one of these days, right? I'm 27th. I think it was Wednesday, 27th. I am going to just guess. I believe that was the day. You know, markets rallied almost 10% in the face of what the Fed was doing.
Mm-hmm.
So that's going to be a VIX crusher in itself, right? And I think it's these moves that, without the market hasn't really broken down too aggressively, for that VIX trigger, for that volatility or for the VIX to chase illiquidity at this point. Not to say that it won't happen, though. That's the thing. We don't know where we have to watch this where the terminal goes. This is what I was saying to you earlier, saying to the listeners, right? If the terminal rate peaks around 500 basis points and goes sideways and inflation slowly comes down, well, confidence in the market will rise, right? That inflation is getting under control, and the illiquidity index will drop. You see what I mean?
Yeah.
And
And
maybe
catch
this
back
comes,
up with the VIX.
yeah, right. Or we get a black swan event where VIX rips. And I know some of you guys might be confused because just earlier we were talking about a risk on pivot. Remember, We're talking about a risk on pivot within a risk off regime, which is why it's called a non confirmatory regime. We're not bullish, we're bearish because the system is bearish, right? So don't get confused with our viewpoints and our stances because I can have a viewpoint about anything, but it's where I stand when the battle comes, which is where it matters, right? So if I were to say, "Oh yeah, I can tell you all these things about how bullish things can get, or how much risk assets and like SPY could rally," doesn't mean I'm telling you we're gonna be in a new bull market. It just means that I understand that there is some upside risk here, and I want to plan accordingly. Quite frankly, the last run we had in August, this Fed thing, I didn't expect that type of move to happen. I was expecting the complete opposite to happen. But I was overall bearish regardless, right? You
Hmm.
understand? Like
Yeah.
we're talking about short-term price momentum where prices can go, but like the long-term system is telling us risk off, and that's where I'm going to have to stand. I'm not going to argue. I'm not going to sit here and argue my own system. The system says risk off, and it knows better than me. It knows more than me. It processes more than me. It understands better than me, right? So why am I going to sit there and debate it? It is
Yeah,
what it is,
exactly. We
right?
we we develop a theory around what the system is telling us. And so
Right,
right now
exactly.
we've got our bearish theory. We are trying to develop a bullish theory, but there really is not much going in that direction right
Right,
now.
exactly.
But that will shift as the system starts to shift more towards risk on probabilities. You will be seeing more bullish news coming out. That's just how it works.
Right. And look what we're seeing here with the dollar, right? We're seeing the dollar just rip. We're seeing the dollar now year to date. It's been a monster, 111, right? On the DXY.
Yep. And we
Um
just got some Japanese yen intervention, which is slowing
yeah.
down this move in the dollar as well.
We'll go over that in a few minutes though. Yes, that was one of the biggest events from last week. It's actually kind of convoluted though the way it happened. The news reporters claim that the BOJ's intervened, excuse me, and the officials claim that they will not comment. So there's a rat in the loop somewhere, right? There might have been official reports come out since then, but at the time when news was breaking, one side said no comment, the other side said there was an intervention.
Well, I
So
mean, look at the chart.
yeah,
There
I
was
mean,
obviously intervention.
we know that there's an intervention, but it's quite odd to not see an official release
Yeah.
while it was happening, kind of like hiding in the shadows. It's just interesting to see. Obviously, we had many people at the beginning of the year on Twitter, uh, paid people people with paid services claim that the dollar is done, and I like to keep a little memento here of you know, just where those claims came in and where the dollar is now. It's quite impressive. And for a dollar index, we're talking over 17% on the United States dollar. Quite crazy.
That's quite a
Um,
move.
yeah, but let's go into the Japanese yen and exactly what you said. And we're quoting this in the amount of yen for $1. So this is quoted in the amount of yen for $1. So 147 yen is equatable to $1, one US dollar. Now, what happened? Well, we saw the first intervention happened here. I believe it was on Thursday, September 22nd. We saw the first intervention occur, and then we saw just on Friday the Friday into the middle of the day we saw the second intervention occur.
Hmm.
So the original BOJ wall was about 146, 145. It was in this area. We went all the way up to 150, 151. So obviously, the market said kind of gave the BOJ the middle finger and started
Yeah,
ripping.
and they must have panicked and
Must have panicked and they started the
intervened.
intervention. Yes. Now I've been saying this on Twitter, but I'd like to clarify it here that the BOJ has two options: save their currency or save their bonds. Okay, and you might not understand why I say this, and I'm going to go over that in a second, but it's very important to understand the dynamic of what they have to do to save either. Okay? So to save their currency, right, they have to be the buyer of last resort in their currency. Now, that means they need to swap dollars for yen. They may have some currency reserves, right, of dollars. They can swap the yen deal. They can do some FX borrowing. They can basically artificially um, put a position on via derivatives to get long yen, right, to be a buyer of yen. But with the amount of money that they need to come in with, the best option is cash, right? Is actual converting dollars to yen. Now, the problem that you run into is the way that they're going to get those dollars, right? So to raise those dollars to convert to yen, once their cash reserves are depleted or they no longer have cash reserves, they have to sell dollar denominated assets. And it's the worst thing to do because what it's going to do is it's going to push our yields higher. Because unfortunately, most people may not know this. The BOJ is one of the largest holders of US Treasuries, foreign at least, right? So I believe overall, but I know foreign. So they are the largest holder of US Treasuries in the world. And they have over $1 trillion in treasuries. They're going to try and get as much cash out of that in an emergency scenario that they can. Well, unfortunately, it's kind of like these funds that blow up. They slowly accumulate and start dumping at once, right? I'm not saying this is not me saying they're going to dump one point whatever trillion dollars of treasuries all at once. That would be catastrophic. I don't think they would do that. I don't think they need to do that. But they will most likely, if they get to the point where they have to use treasuries to fund or save the yen, right? They're going to have to sell consistently and a bit aggressively. I'm not talking about their whole position because they need to raise dollars quickly, efficiently, and make sure that the bid stays in or the wall stays intact because obviously the wall is not working. The market just tried to basically again say F you to the BOJ, and the BOJ said, nope, we're going to intervene, right? Now, this is where the dilemma comes in. Either you save the yen or you save the Japanese government bonds. For example, I have a chart here of the 10-year and 30-year Japanese government bonds. Now, they tend to move in tandem, right? They're longer ends, right? You go past 10 years, you're really on the longer end of the yield curve, right? That's how that works. So they're going to move in together, most likely, right? Yields, I mean, they're not going to move at the same rate, but if they go up, and for example, here's the Japanese 20-year. Let's throw that on here, right? So as you can see, go up together, right? Like we'll take the 20-year and the 30-year. 30 years white, 20 years this um, yellow, and the 10 years the orange. You see how the 20 and 30-year are rising, 10 years not. Now,
So the
why
curve is
is that?
normalizing.
Well, no. What's going on here is simple. I'm going to tell you what's going on here. The yield curve control, right? So the way that this works is the reason yields are not breaking up like this is because the BOJ is basically the buyer of last resort. The BOJ holds over like 50% of Japanese of treasury bonds. Now, how do they do this though? Right? Because if you think about yield curve control, how does that work? If I'm going to sit here and say I'm going to buy, I'm not going to let yields get above like 30. Yields haven't gone above 30 basis. Just look at the price difference, right? 25 basis points or yield difference, 25 basis points for 10 years, 1.6% for 30 years. Think about that difference, right? Now, what's going on here is the BOJ, what they're doing, right, is or I should say Japan, but we'll use Japan as a whole. Japan is financing their QT or their yield curve control, right? Not QT, they're basically QE, by being the buyer of last resort with unlimited options. Meaning, if let's just say the entire market wants to push this yield higher, the BOJ or Japan will print an unlimited amount of money to make sure this yield doesn't go up and be the buyer of last resort, which is why their balance sheet is 600 something trillion dollars. because and it's not specifically from the from their 10-year bond, right? I'm not saying this is the culprit, but I'm saying this type of unlimited printing is why their balance sheet is, almost it's almost nine times, whatever, 90 times greater than ours.
Yeah. And so now they're facing the repercussions of that, of their currency getting destroyed at an extremely fast pace.
Right. And if so, the dilemma here is if you want to fix this, you need to sell US treasuries to raise dollars to take yen off the market. But
Yeah.
here, you're going to print unlimited yen and put it into the treasury market to keep the yields low.
So they're really stuck between a rock and a hard place right now.
Right. The question is, what are they going to do? Are they going to be? Can they pull it off? Can they print yen, control the yield curve, and pull yen out of the market and kill the dollar ratio? Right now, I know we can have the debate. The BOJ buying the Japanese bonds is not putting money directly into circulation the same way that there's available yen on the market, right? With the whole thing that when you buy bonds, it's got to bleed into the market, right? That's because the money's going to the treasury, it's got to be spent, it's got to be sent out. It's not immediate,
Hmm.
right? Neither really is what they're doing here with this intervention, but it's more direct than buying bonds. And there's obviously a debate of what they're doing with their currency. Can they outrun what they're doing with the yield curve at the same time? And if we take a look, this is the yield curve. For example, this is their yield curve, and their 10-year is sitting right here. And then after that, look what happens,
Yeah, because they don't
right?
they don't do control of the 30s and 20s, right?
Well, I mean, if
Or
they no,
not
they
as
don't.
not as well.
No, no. I mean, I don't think they could. You have to realize the amount of money it takes to control a yield curve. No, I mean, there's also theories that you can issue. Okay, it's been done right where you issue short-term bills or short-term bonds, and you go out there and you buy. You basically use one to feed the other, right? Yield curve control.
Hmm.
But when you're talking about a sustainable plan, yield curve control is is nested in the idea of modern monetary theory, right? The idea that we can just print money and have no repercussion.
Yeah.
And there's debates on this. Um, we can look at certain countries. Maybe we'll have a podcast like that next week where we talk about worldwide inflation implications. But the idea that printing, so the number one root cause for inflation is the increase in money supply. That's literally the only reason that we have inflation, right?
Yeah.
If the money supply never increased, we would have just perpetual deflation,
Yeah. And
right?
basically every country printed half of their money supply during COVID.
Right. But unfortunately, the theories of modern monetary theory, right? The theory itself is that we can just print indefinitely and experience low, controllable inflation. But I think we've cracked a new age where we're going to start disproving some of those theories. I personally don't believe that obviously it's illogical if you really think about it. Now you kind of have your theories about, okay, look, there's certain countries that inflation is slowing while they're cutting rates, right? We're talking about hyperinflated countries, maybe like Turkey, for example. But in the end, in the end, the money supply itself, the total supply, will dictate where inflation is going to go. And if you keep on increasing that supply, and we can bring this down to really just preschool level stuff, bring it down to the pizza pie. If there's 8 people, they each got a slice, and they each paid X for their slice, and then you just throw another pie on the table, what do you do to the value of pizza?
Yeah.
You,
It's
yeah,
just
you
there's
you
more
drop you
pizza.
dropped it. Right. There's more pizza now. So okay, well, think of it like shares of a company. It's a little bit more advanced than pizza, but like, you have 100 shares of a company that's worth, $1 a share, $100 total, and you just issue another 100 shares. What happens to those people? Like if they're not proportionally acquiring those shares equally, and that's going to other people, well, they just got diluted, and that's what inflation is. And over time, we see falls and or rising and falling empires around the problems of inflation, right? Like,
Because they forget about this basic law of nature.
Right. The more you have of something, the less it's going to be worth.
Yeah.
But I think that's where we can finish off this week's podcast. If you have any questions, feel free to reach us at our free Discord. The website to our website is www.market-radar.com. If you like this video, please like and subscribe to get the latest releases from Market Radar.